Mike, tell me, what is macro? What do you actually do?
It's funny, people have a lot of different ideas of what global macro is, and so, part of the core are the assets we trade are big stories. They're the macroeconomic stories of the world. Global imbalances, business cycles. Will the euro survive? Will the Chinese growth model, change? Will they move the renminbi peg? And so that's part of it. But really, when I think of macro, I think of a focus on risk control. The great macro traders started from a risk background. Most of the great long-short equity managers that you'll interview started in research. They were stock guys, they were story guys, they weren't risk guys. Macro guys have a different mindset. It's all about risk. Part of it's because when you're moving in the speculative world, there are so many different data points that could influence something. There's so many factors that you're really never that sure. I talked earlier about guessing. This is the guessing business. And so at macro trader's core, he has to realize he's just not that smart. He's not a fundamentalist. And so stop losses have a lot to do with it, right? You've got to be flexible with your mind, flexible with your capital. And so staying liquid is an important part of being a macro fund. Liquid enough and the world changes, you're in big trouble. If you're a fundamental investor, you really you're leaning on something you believe in. And I think that's the big difference. And so there are some macro guys that are fundamentally, it's really a different business. It should have a different category. But when you look at, the Bruce Coveners and the Paul Joneses and Louis Bacons and the way they've traded macro, and there's a new crop, Alan Howard, of traders in that genre, it really is a primary focus on risk. And that's what we try to do here at Drawbridge and Fortress. It's kind of risk first.
Mike, let's drill down a little bit more on this so important risk control and risk component of your business. How particularly do you manage risk? What else do you take into account? How do you operate beyond the stop loss?
To start with, there is a DNA of a macro trader that just hates losing money and fears losing money. And I say that, without having a tongue-in-cheek. It really is true. The guys that you want to emulate as a macro trader, you look at very few down years, very few bad drawdowns, and so there is a defensive nature to the mindset. We look at lots of different risk measures. We look at our volatility and our VAR, and quite frankly, vol and VAR work perfectly in a world where you're only trading liquid things that are freely marked and freely moved every day. And outside of that world, anything, a peg currency, a currency where a government is one big side of the volume, anything with negative convexity, credit bets, short gamma portfolios, highly leveraged positions, so relative value type stuff, any of that stuff, vol and VAR doesn't work for. And you really have to bespoke risk manage it. You have to go through and use a common sense approach. How much money can I lose? What we hope to do is to be long fat tails and not short fat tails. All of those things in the convexity bucket often, trade as fat tails. And so there's a two-pronged approach to risk management. Some is vol and VAR, and that works. And that drives probably 90% of it. But the important part is understanding where the danger lies, and that's in that what I call bespoke risk management sheet of things. And sometimes you'll go through your portfolio and 97%, are in the liquid, purely tradable space. A lot of macro funds got themselves into trouble in 07, 08 because the credit bubble and the great moderation, that long period of time of low volatility, got people lazy, and they, ourselves included, slipped into more and more versions of the carry trade where you really were, short convexity and short liquidity. And so, it really is that focus on risk that, we try to do, and, the better you do it, the better you do.
Mike, how has your fund now evolved, and at which point are you now? How big is it? What do you do on a daily basis? How many people do you have with you working on that fund?
So, this is a story of, I started the fund very small in 2002. We were $40 million and probably 8 people. It was a one portfolio manager fund for a few months, and I quickly realized that, my partner Adam Levinson and I did far, far better if we each had our own capital. Originally, I was going to make the decisions, and he was going to be an analyst, and that lasted about 2 months. And he had a strong personality and a real need to manage capital, and so we really kind of co-run the fund in a lot of ways. He's much more detail-oriented than I am, and I'm much more kind of intuitive and big picture, and so it's been a good partnership. We grew the fund as large as $9 billion at our high. At that point, we had developed more of a multi-strategy macro fund, modeling ourselves in a lot of ways after Caxton or the Tudor Group. In '08, ran into trouble with a lot of complexity in our fund, and so we restructured at the end of '08, really back to the core roots, where now there's 4 portfolio managers, 2 of us taking about 85% of the risk. There's a big team of analysts, strategists, traders. So we probably have 45 people in the back office, risk management, operations, accounting, and so forth.
What's the history of Fortress? Everybody knows you, of course, as a publicly listed company, but tell us more. What's the beginning of Fortress, and how many business areas have you evolved since then?
So Fortress, existed before I joined. Wes Edens founded the company with 3 partners way back in 1998. I joined in 2002, and Pete Brigger and I had both been partners at Goldman Sachs. We were trying to figure out what to do, and Pete called me up and said, let's do something together. I said, I'm trying to figure out what we're going to do. Wes offered us free office space, and we were just officing there, and he had about a $900 million business with 40 employees. And one day, literally over a dinner, Wes and I had a very similar idea that you could create a multi-strategy business. 1 plus 1 plus 1 plus 1 would equal a lot more than 4. And so we agreed to, partner up together. And from the very start, we made it an old school partnership, which, with hindsight, I scratched my head and always decided was it the right thing or the wrong thing, but it's what we did. Part of that was the Goldman Sachs history. And so all of us threw all in. And even though we spend 95% of our time on our own businesses, we shared all the economic ups and downs, and so we were completely aligned about our business. Wes grew the private equity business from the $900 million that was there when we started into a colossal business. At one point I think we had, we still have, I think, 15, 16 billion under management. Pete Brigger went off and built a credit business or a distressed business, or sometimes I call it an idiosyncratic credit business, but it's really special opportunity type credit. He had run the ASSG business, the special opportunities business at Goldman Sachs, is probably one of the world's best trash pickers. He buys dimes for nickels. And that's a big business for us now. There are 450 people in his fund. It manages about $13-14 billion. And I was charged with growing the liquid hedge fund business. And today we have 2 liquid hedge funds. We have the macro fund and the commodities fund. Our plan is to slowly launch more and more hedge funds, as opposed to rebuilding the macro fund with a wide range in portfolio managers. It's to have a macro fund, have a commodity fund, in time a long-short fund, a liquid credit fund. And so we're going to grow in this environment by new businesses, not making one fund really big.